You don't need an economics degree to know inflation is real. You just need to buy groceries. One month, CPI says inflation is cooling. The next month, markets panic like someone spilled coffee on the Federal Reserve's keyboard. So what's actually happening? And why do stocks, gold, oil, and commodities lose their minds every time CPI and PPI drop? Because every month we get new CPI numbers. Markets go wild for about 6 hours. Financial Twitter melts down, and suddenly everyone's an economist again. But here's the real question. What should you actually care about? Let's decode the chaos. Without the jargon, without the drama, and without pretending we run a central bank. First, let's decode CPI without falling asleep. CPI stands for Consumer Price Index. It measures the price of things regular people buy: food, rent, gas, services, healthcare. Basically, the stuff that makes you look at your bank account and sigh. When CPI rises, inflation is rising. When CPI cools, inflation is slowing. Now here's where markets get dramatic. If CPI comes in lower than expected, stocks often rally. Higher than expected, stocks often sell off. Exactly as expected, markets still find something to panic about. Because markets don't just care about inflation, they care about expectations versus reality. Quick question. If inflation drops from 6% to 3%, are prices going down? No, they're just going up more slowly. Inflation cooling doesn't mean cheaper groceries. It just means they're hurting you more politely. What about PPI, the sneaky indicator? PPI stands for Producer Price Index. Think of it as CPI's older sibling who sees things first. PPI measures the prices businesses pay for inputs, raw materials, energy, components. If PPI rises sharply, it often trickles down to CPI later, because companies don't just absorb higher costs out of kindness, they pass them on. So when PPI spikes, markets start thinking, CPI might follow. And when PPI cools, markets breathe a little easier. Why stocks care so much? Inflation affects stocks in two big ways. One, it impacts corporate margins. Two, it influences Federal Reserve policy. Let's unpack that. If companies face rising input costs, thanks PPI, but can't raise prices enough, CPI resistance, profit margins shrink, and Wall Street hates shrinking margins. On the flip side, if companies can raise prices without killing demand, that's pricing power. And pricing power is basically corporate superpower. Now layer in the Fed. If inflation is high, the Fed may raise or hold rates higher. Borrowing becomes expensive. Growth slows. Stock valuations compress. If inflation cools, rate cuts become possible. Liquidity improves. Valuations expand. See how CPI doesn't just affect your rent, it affects trillions in market value? Let me ask you something. When markets rally on cooling inflation, are they celebrating lower prices or celebrating the possibility of cheaper money? Hint, it's usually the second one. Commodities. The inflation feedback loop. Now let's talk commodities, because commodities don't just react to inflation, they help create it. Oil prices rise, transportation costs rise, goods cost more, CPI rises, food prices rise, grocery bills rise, CPI rises, metal prices rise, construction costs rise, housing costs rise, CPI rises. So commodities are both a cause and effect of inflation. That's why commodity markets are so sensitive to inflation data. If CPI comes in hot, gold may rally, inflation hedge. Oil may spike on demand expectations. Industrial metals react based on growth outlook. If CPI cools sharply, gold may pause. Oil could soften. Copper might react to growth expectations instead. It's a constant chess match. Gold's relationship with inflation, it's complicated. Everyone says gold is an inflation hedge. And historically, that's often true. But here's the twist. Gold doesn't respond to inflation alone. It responds to real yields. Real yield and of course interest rate minus inflation. If inflation is high but rates are even higher, gold may struggle. If inflation is moderate but rates are falling, gold can rally. So it's not just inflation up or gold up. It's monetary conditions relative to inflation. Subtle difference, huge impact. If gold were a person, it wouldn't panic about inflation. It would panic about central banks reacting to inflation. Gold doesn't fear prices, it fears policy mistakes. Oil. Inflation's loudest friend. Oil is one of the fastest ways inflation can reaccelerate. If oil spikes, gas prices jump, transportation costs rise, airline tickets rise, food shipping costs increase. Suddenly, CPI starts climbing again. That's why central banks watch oil closely. But oil also depends on global demand, OPEC decisions, geopolitics, supply disruptions. So oil can move independently of CPI, but still end up influencing it later. It's like that friend who says they're staying out of drama, and then starts all of it. Inflation, growth, and market personality. Swings markets behave differently depending on the type of inflation. Let's simplify. Scenario 1, controlled disinflation. Inflation cools gradually, growth remains stable, stocks rally, gold stabilizes, commodities stay supported. Scenario 2, reaccelerating inflation, oil rises, CPI surprises higher, rate cuts get delayed, stocks wobble, gold often benefits. Scenario 3, deflationary shock. Growth slows sharply, commodities fall, stocks drop. Gold sometimes outperforms as a safe haven. See how inflation isn't just one story, it branches. Let's zoom out. What if the biggest risk isn't high inflation, but inflation uncertainty? Markets hate not knowing more than they hate bad numbers. Consistency is calming. Surprises are expensive. Global inflation, not just US. Here's something often overlooked. Inflation isn't just a US story. Europe, the UK, and other Western economies are dealing with energy volatility, wage pressures, housing affordability issues, fiscal spending expansion. When global inflation shifts, currency markets react. When currencies move, commodities move. When commodities move, CPI moves again. It's a loop, a messy global loop. What investors should actually watch. Instead of obsessing over headlines, here's what matters. 1. Core CPI trends, excluding food and energy, wage growth, PPI momentum, oil and energy prices, bond yields, central bank tone shifts. Watch trends, not one-month spikes. Markets often overreact to single prints. The real story is direction, confession time. Half the time markets move, it's not because inflation changed dramatically. It's because expectations were slightly off. Sometimes a 0.2% surprise moves billions of dollars, which is wild, and also very Wall Street. So where are we now? Right now, inflation globally appears lower than peak levels, but still above long-term central bank targets. Sensitive to energy and wage pressures. Vulnerable to geopolitical shocks. That means markets are in a balancing act. Stocks want inflation to cool. Gold wants real yields to fall. Oil reacts to supply. Copper reacts to growth. And the Fed wants everyone to calm down. It's like economic group therapy, but with trillions of dollars involved. Conclusion. Inflation is the steering wheel. Inflation data is not just a statistic. It's the steering wheel of markets. CPI moves expectations. PPI signals pipeline pressure. Commodities amplify or dampen the cycle. Central banks respond, markets reprice. Understanding inflation isn't about memorizing percentages. It's about understanding how price pressure changes behavior, consumer behavior, corporate behavior, investor behavior, policy behavior. And in 2026, inflation isn't screaming anymore, but it's definitely not silent. If you found this breakdown helpful, and hopefully a little less boring than a textbook, subscribe for weekly macro conversations that make sense of the chaos. And I want to ask you, do you think inflation makes a comeback this year? Or are we heading towards stability? Drop your view below. Because in markets, inflation may not be funny, but understanding it can save you a lot of stress. See you in the next one.